Welcome back, candidates. We're now going to move on to look at the acquisition method. Now, the acquisition method is used for subsidiaries, and subsidiaries are entities where we have control. So we control the investing, the financing, and operating decisions. Now, once you have subsidiaries, you are going to need to produce consolidated group accounts. I'm just going to flip to a white screen for a second, just to explain what I mean by that. So let's imagine you've got a parent company. Okay, and the parent has some subsidiaries, sub 1, subsidiary 1, subsidiary 2, subsidiary 3. Now, each of the companies produces their own balance sheet. So the parent produces a balance sheet and, of course, income statement. In other words, they all produce their own accounts. So sub 1's got a balance sheet and an income statement, a balance sheet and an income statement, a balance sheet and an income statement. But when you have this situation with a parent and then subsidiaries, what you have to do is produce group accounts. Now, what your group accounts are trying to do is show all of these entities as if they were combined. In other words, what they're doing is they're putting them all together, saying, let's combine all of these and present the results to the shareholders of the parent company. Now, group accounts are often referred to as consolidated accounts. So we're going to combine all of these entities as if they were one company. Good. Okay, let's return to our slides. So what we've now got is the techniques that we are going to apply. Now, point 1 for the balance sheet says eliminate the investment count of the parent. What the parent is going to do is it's going to show in its accounts the investments that it made in the subsidiaries at cost, i.e. at the price that they paid. But that's not what we're going to show in the group accounts. What we're going to show in the group accounts is goodwill and all of the assets and liabilities that we've acquired on a line-by-line basis. So if you remember with equity accounting, we had a one-line consolidation. And of course, at the date of acquisition, that was equal to our purchase price. And if you remember with equity accounting, that included our share of book value, net assets, our share of any fair market value adjustments, and then any balance was goodwill. Well, what we're going to do under group accounts is we're going to show all of these items separately. And in fact, we're not even going to net the assets against liabilities. We're going to bring in 100% of the assets and liabilities on a line-by-line basis. But what it does mean is if you were to bring in the assets, liabilities, and goodwill and show them in the group accounts and include the investment amounts from the parent's accounts, i.e. what they'd paid to acquire the subsidiaries, you would have double counted everything. So we must eliminate the investment account of the parent. It also says we need to eliminate the equity accounts of the subsidiary. Now, there's a slight caveat to that, which we'll talk about in 2 seconds. But again, we can see this by going back to our diagram. He says, trying to get the diagram back up. There it is. Look, if you're going to present all of these companies as one, it is only the external equity that the parent company's shareholders own that should be reflected in the group accounts. So we're going to show the common stock and the additional paid in capital of the parent company only in our accounts. But what about retained earnings? Well, we are going to include the retained